America is racing toward an economic breaking point, and the numbers are terrifying. More than $35 trillion in national debt, climbing by nearly $1 trillion every 100 days. That's over $15,000 hanging over every taxpayer's head, and the clock is ticking. But here's the truth no one in Washington will admit. This isn't just about big government debt. This crisis is already hitting ordinary Americans. Families are one paycheck away from losing everything. Entire towns are being hollowed out, and entire states are on the verge of collapse. Think about it. What happens when your hospital shuts down, when your school can't stay open, when bridges literally start falling apart, and the state can't afford to fix them? The next recession won't hit all states equally. Some will struggle, but others, they'll implode. Today, we're counting down the 10 U.S. states most likely to collapse first when America's economic house of cards finally crashes. And some of the names on this list might shock you. Number 10, West Virginia. West Virginia stands as America's most sobering warning of what long-term economic collapse looks like in slow motion. Once the beating heart of coal country, the state has seen its primary industry shrink by over 75% since 2010, wiping out tens of thousands of stable, high-paying jobs that once supported entire towns. With nothing substantial to replace coal, West Virginia has been left adrift, relying on low-wage service jobs and federal assistance to keep communities afloat. Nearly 20% of residents live below the poverty line, compared to the national average of 12%, and the state's median household income hovers around $55,000, almost $15,000 lower than the U.S. median. The labor force itself has collapsed. Only about 54% of working-age adults are employed or actively seeking work, meaning nearly half the state's potential workforce has checked out of the economy entirely. This isn't just unemployment, it's economic surrender. The opioid epidemic has deepened the crisis, with West Virginia leading the nation in overdose death rates, hitting 84 deaths per 100,000 residents in some counties. This public health disaster drains billions from state resources each year, while simultaneously shrinking the workforce and hollowing out entire communities. Population decline adds fuel to the fire. Since 2010, West Virginia has lost over 100,000 residents, a 6% decrease in just over a decade. Young people graduate high school or college and leave immediately, chasing opportunities in places like North Carolina, Ohio, or Texas. What remains is one of the oldest populations in the nation, with nearly 21% of residents over age 65. That means more strain on healthcare and pensions while fewer workers are around to support the tax base. Infrastructure is collapsing just as fast. The state carries a massive backlog of road, bridge, and water system repairs, with some counties reporting 1 in 5 bridges structurally deficient. Budget reserves are razor thin, forcing West Virginia to rely heavily on federal transfers that account for more than 35% of its entire state budget. If Washington tightens the tap or another recession slashes revenues, the state will have no cushion. West Virginia isn't preparing for collapse, it's already living it. The only question is how much further it falls when the next shock wave hits. Number 9, Mississippi. Mississippi holds the unfortunate title of being at the very bottom of nearly every major economic ranking in the United States. With a median household income of just $48,000, it lags nearly $22,000 below the national median, leaving millions of families with barely enough to scrape by. Poverty is entrenched. Nearly 20% of Mississippi's residents live below the poverty line, and in some rural counties, that figure explodes to over 35%, creating entire regions trapped in generational hardship. The state's workforce participation rate tells the same grim story. Only about 56% of working-age adults are employed or actively seeking work, the lowest rate in the nation. This signals more than unemployment. It's widespread economic despair, where tens of thousands have simply stopped trying. The state's education outcomes reflect the problem. Mississippi consistently ranks 50th in national test scores with underfunded schools, and limited higher education opportunities driving out talented young people who never look back. Healthcare is another pressure point. Mississippi has the highest infant mortality rate in America and one of the lowest life expectancies, with residents living 5 years less on average than the national standard. Rural hospital closures continue to mount, leaving some communities over an hour from the nearest emergency room, with 14% of residents uninsured. A single medical emergency can spiral into bankruptcy. Infrastructure is equally fragile. Nearly 25% of Mississippi's bridges are rated deficient, and the state carries a multi-billion-dollar backlog in road and water system repairs. Jackson's repeated water crises are just the tip of the iceberg. The state's budget has almost no rainy day cushion, heavily reliant on federal transfers for over 40% of expenditures. The combination of poverty, poor health, weak education, and shrinking labor force leaves Mississippi frighteningly exposed. When the next economic downturn hits, the state doesn't just risk recession, it risks collapse into something much darker: systemic failure of basic services. Number 8. Michigan. Michigan is often held up as the great comeback story of the post-2008 crash. But beneath Detroit's revitalized downtown lofts and Ann Arbor's high-tech corridors lies a state still deeply fractured. While the auto industry has recovered partially, Michigan remains dangerously dependent on a sector that can vanish overnight. With global supply chain shocks in 2024, nearly 20% of Michigan's entire GDP still came from manufacturing, leaving the state exposed to downturns in global demand. Household finances paint a stark picture. Michigan recorded one of the highest rates of financial distress in America, with over 40% of residents struggling with overdue bills, medical debt, or defaulted loans. The median household income of $63,000 sits below the national average, while poverty remains widespread, especially in Detroit, where some neighborhoods still see poverty rates above 30%. Population decline is another ticking bomb. Between 2020 and 2024, Michigan lost over 100,000 residents, with entire towns hollowing out as families moved south and west. This exodus drains tax revenues and leaves behind aging, lower-income populations dependent on already strained public services. Nearly 21% of Detroit's housing units sit vacant, creating blight and dragging down surrounding property values. Infrastructure is among the worst in the nation. The state's roads are infamous, with 45% rated in poor condition, and repair needs topping $7 billion annually. Water crises extend far beyond Flint. In some counties, lead contamination remains a daily risk, while outdated sewer systems threaten public health with every storm. Healthcare and addiction amplify the crisis. The opioid epidemic continues to batter Michigan, with overdose deaths doubling in the last decade. Rural hospitals face mounting closures, leaving some regions medically stranded. When the auto industry sneezes, Michigan catches pneumonia. A single downturn in car sales could eliminate tens of thousands of jobs, triggering another foreclosure wave like the 2008 crash, when Michigan led the nation in home repossessions. Without diversification, the state's fragile recovery will unravel, reminding America that rust never sleeps, it spreads. Number 7. Alabama. Alabama may boast cultural pride, college football glory, and natural beauty, but underneath its economic foundation is eroding fast. The state's median household income sits around $59,000, placing it in the bottom 10 nationally, while nearly 16% of residents live below the poverty line. This isn't just an economic number. It's daily life for nearly 800,000 Alamians struggling to make ends meet. Education, the backbone of future growth, is one of Alabama's greatest weaknesses, consistently ranked among the bottom 5 nationally. Public schools suffer from chronic underfunding, teacher shortages, and low graduation rates. Only 27% of adults hold a bachelor's degree or higher, well below the national average of 36%. This educational gap cripples the workforce pipeline, driving educated young people to leave for opportunities in states like Georgia or Texas. Healthcare is another crisis. Alabama chose not to expand Medicaid, leaving nearly 300,000 residents without affordable health coverage. The result, a wave of rural hospital closures, more than 15 since 2010, leaving large swaths of the state in medical deserts. Alabama's infant mortality rate is among the highest in the nation, and life expectancy lags by 3 years compared to the U.S. average. Infrastructure decay compounds the problem. Alabama's roads and bridges earned a D+ rating from engineers, with over 16% of bridges structurally deficient. Broadband access in rural areas is spotty, limiting job creation and trapping communities. In cycles of underdevelopment, the state budget is equally fragile. Alabama maintains one of the thinnest rainy day funds in America, leaving it exposed when revenues fall. Heavy dependence on industries like aerospace, automotive, and agriculture makes Alabama vulnerable to global trade shocks and downturns. When the next recession arrives, Alabama won't just face economic strain, it will face the possibility of services breaking down entirely, schools closing earlier, hospitals turning patients away, and communities left stranded as the cracks in its foundation finally split wide open. Number 6. Arkansas. Arkansas doesn't make headlines like California or New York, but its crisis is quieter and just as dangerous. The state's median household income is just $53.00, ranking among the lowest in the nation. While 15% of Arkansans live in poverty, rural areas face the harshest blows, where job opportunities are scarce, health care is miles away, and small businesses disappear one after another. Health care accessibility is dire. Arkansas has one of the highest uninsured rates in America, with over 100,000 residents lacking coverage. In rural counties, residents often drive 50 miles or more just to see a doctor. Since 2010, 10 rural hospitals have shut their doors, leaving thousands vulnerable in emergencies. Medical debt remains a leading cause of bankruptcy in the state. Education outcomes remain weak. Fewer than 25% of adults hold bachelor's degrees, limiting upward mobility. Rural schools suffer from outdated facilities and underfunded programs, while teacher shortages make it harder to raise performance levels. Without strong education, Arkansas struggles to build a modern workforce attractive to high-tech or diversified industries. Economic reliance is another red flag. Walmart, headquartered in Bentonville, is the state's largest private employer, but even Walmart is cutting costs and automating jobs, leaving tens of thousands of workers at risk. Agriculture and manufacturing still form the backbone of Arkansas's economy, but declining profits, overseas outsourcing, and trade volatility make them unreliable. Infrastructure tells the same story of neglect. Arkansas lags behind in broadband access, leaving nearly 40% of rural residents without reliable internet. In 2025, that's an economic death sentence. Roads and bridges require billions in upgrades, but the state operates on a shoestring budget. Nearly 45% of its general revenue comes from federal transfers, making Arkansas dangerously dependent on Washington's spending priorities. Arkansas's crisis isn't explosive like a housing crash or Wall Street meltdown. It's a slow bleed. Families leaving, hospitals closing, jobs disappearing, and young people never coming back. The silence hides the struggle, but when the next recession strikes, Arkansas will discover how fragile its quiet economy really is. Number 5. Kentucky. Kentucky is the textbook case of what happens when entire industries collapse and nothing rises to replace them. Once defined by coal, the state has watched its backbone industry disintegrate. Coal jobs have fallen by more than 60% since 2010, leaving counties in eastern Kentucky with unemployment rates that hover several points above the national average. The result, generational poverty that refuses to loosen its grip. The numbers tell a grim story. Kentucky's median household income is around $57,000, ranking 47th in the nation, while nearly 17% of its residents live in poverty. In some Appalachian counties, that rate soars to over 25%, with families surviving on food stamps and disability checks. Workforce participation remains dismally low. Only about 58% of working-age adults are in the labor force, far below the national average. Healthcare is another breaking point. Since 2010, Kentucky has lost 12 rural hospitals, leaving residents in remote mountain towns over an hour from the nearest emergency care. Life expectancy trails the U.S. average by 4 years, and the opioid epidemic has hit Kentucky especially hard. The state's overdose death rate ranks among the highest in America, with more than 2,100 overdose deaths annually, draining both families and state resources. Education fails to provide a lifeline. Only 27% of adults hold a bachelor's degree or higher, and underfunded schools in rural regions struggle with low graduation rates and outdated facilities. This drives young people to leave, creating a vicious cycle where the talent exits and the despair deepens. Kentucky's economy remains over-reliant on declining industries like coal and tobacco. While struggling to attract new investment, infrastructure needs pile up. Nearly 1 in 10 bridges are structurally deficient, and rural broadband remains patchy. When the next recession strikes, Kentucky doesn't just risk higher unemployment, it risks complete economic abandonment of entire regions. Forgotten in the mountains, the state already teeters between survival and collapse. Number 4. Nevada. Nevada dazzles with the neon lights of Las Vegas, but beneath the glitz, its economy is little more than a high-stakes gamble. Nearly 30% of Nevada's workforce depends directly on tourism, hospitality, and gaming, industries notoriously volatile during downturns. When visitors stop coming, Nevada doesn't just slow down, it collapses. The unemployment roller coaster proves it. Nevada consistently ranks among the most unstable job markets in the U.S., with unemployment swinging from 3.6% to over 4.2% in just a year. During the Great Recession, it soared past 13%, the highest in the country, and thousands of workers never recovered. The housing market mirrors the volatility. Nevada was ground zero during the 2008 crash, posting the second highest foreclosure rate in America. Prices have since rebounded aggressively, rising more than 40% since 2020. But affordability has collapsed. The median home in Las Vegas now costs over $450,000, while median household income hovers around $72,000, stretching families to their limits. Another downturn could easily trigger a new foreclosure wave. Outside of Las Vegas and Reno, the picture is even blearer. Rural counties suffer from shrinking populations, limited healthcare access, and economies reliant on fragile service sectors. Nevada's infrastructure is under extreme strain. 20% of its bridges are rated structurally deficient, and water scarcity is an existential threat. With the Colorado River Reservoir system hitting record lows, the state's budget is equally fragile. Nevada has no state income tax, relying heavily on sales taxes, tourism levies, and gaming revenue. These sources are highly cyclical. When visitor numbers decline, as they did by 30% during the pandemic, the budget is gutted, forcing service cuts. Nevada's economy is essentially a casino bet, glamorous when the chips are stacked, but devastating when the cards fall wrong. When the next economic storm arrives, Nevada isn't just vulnerable, it's poised for collapse as the house of cards it built on tourism crumbles once again. Number 3. Louisiana. Louisiana is a state fighting battles on multiple fronts, and the numbers reveal just how dire its situation has become. Poverty remains entrenched, with nearly 19% of residents living below the poverty line. That's almost 900,000 people, one of the highest rates in America. The median household income hovers at $56,000, placing the state near the very bottom nationally. The economy relies heavily on volatile oil and gas markets, creating a dangerous boom-bust cycle. When energy prices dip, the entire state feels the aftershock. Louisiana's dependence on this single sector leaves it vulnerable to both global price fluctuations and policy changes around renewable energy. Diversification has been slow, and the losses are visible in empty plants, closed factories, and declining small towns. Natural disasters compound every problem. Hurricane Ida in 2021 caused over $75 billion in damages, devastating infrastructure, homes, and businesses. Louisiana simply doesn't have the financial reserves to recover quickly. Each new storm season represents an economic threat capable of wiping out years of progress. Infrastructure is crumbling at an alarming pace. The American Society of Civil Engineers gave Louisiana a D+ rating, with over 500 bridges classified as structurally deficient. Roads, levees, and water systems desperately need billions in upgrades the state cannot afford. Baton Rouge and New Orleans face ongoing flood risks, while coastal erosion swallows a football field of land every 100 minutes. Louisiana also suffers from a staggering brain drain. More than 70% of LSU graduates leave within 5 years, taking their skills and tax dollars with them. The state's population is stagnant and in many rural parishes outright declining. Healthcare adds more weight to the burden with high uninsured rates and hospitals under strain. Access is limited, especially outside major cities. Louisiana isn't just financially fragile, it's physically sinking, both figuratively and literally. A perfect storm of poverty, weak infrastructure, reliance on oil, and recurring natural disasters puts this state on a collision course with collapse. Number 2. Hawaii. Hawaii looks like paradise from the outside. Turquoise waters, luxury resorts, postcard sunsets. But for residents, it's becoming economically unlivable. The median home price has exploded past $850,000, while median household income is just $88,000. That means the average family would need to save every penny for nearly a decade just to afford a standard down payment. For many locals, home ownership is simply impossible. The cost of living is the highest in the United States. A gallon of milk often costs over $6, while gasoline routinely tops $5 per gallon. Food, utilities, and household goods cost nearly twice as much as the mainland because nearly everything must be imported. These costs crush families who already struggle to cover essentials. Hawaii's economy leans dangerously on tourism, which provides nearly 30% of state GDP. The pandemic exposed this fragility. Visitor arrivals dropped by over 70% in 2020 and remain 15% below pre-pandemic levels in 2024. That left tens of thousands unemployed and state revenues gutted. Any future shock, whether global recession, natural disaster, or geopolitical crisis, could devastate the island's lifeline industry again. The exodus is well underway. Native Hawaiians are leaving in record numbers, pushed out by skyrocketing housing costs, vacation rental conversions, and wealthy investors buying up properties. Between 2010 and 2024, Hawaii lost tens of thousands of long-term residents while gaining transient populations of retirees and foreign investors who can afford inflated costs. Healthcare and infrastructure are also fragile. The islands face doctor shortages, with rural areas often lacking adequate medical facilities. Import dependence means supply chain disruptions immediately translate into empty shelves. Energy prices remain among the highest in America, and Hawaii imports nearly 80% of its food, creating extreme vulnerability during global crisis. Hawaii may be paradise for the wealthy, but for average residents, it's a financial nightmare. When the next economic storm arrives, this fragile island economy could sink faster than any mainland state. Proof that even paradise can collapse. Number 1. Illinois. Illinois may boast gleaming skyscrapers in Chicago, world-class universities, and a proud industrial history. But behind the facade lies one of the most dangerous financial crises in America, the pension bomb. The state's retirement systems are underfunded by a staggering $139 billion. A shortfall so massive it equals nearly $11,000 for every single resident, including infants. This pension hole is the deepest in the nation, and it grows wider every year. The credit agencies have taken notice. Illinois is the only state with a credit rating hovering just above junk status, making borrowing costs higher than almost anywhere else. Every economic downturn forces the state to issue more debt, pushing interest payments higher, while basic services like schools and healthcare are left underfunded. taxes tell the next part of the story. Property taxes in Illinois are among the highest in the nation, with some homeowners paying to 0.2% of their home's value annually. Just in property taxes, for a modest $300,000 home, that's over $6,600 every year, crushing families and driving residents to flee. In 2020 alone, Illinois lost over 83,000 residents, one of the largest population declines of any state. Those who leave are typically higher earners, further eroding the tax base and worsening the spiral. The state's economy, while large, is increasingly uneven. Chicago's downtown thrives with finance and tech, but much of the rest of Illinois struggles with declining manufacturing, shrinking small towns, and underfunded school districts. The median household income sits at $75,000, close to the U.S. average. But rising living costs and relentless taxes make it feel much lower for middle-class families. Infrastructure needs billions in repairs. Nearly 2,400 bridges are structurally deficient, and deferred maintenance grows each year as funds are diverted to cover pensions and debt service. Social services are stretched thin with long wait times for healthcare and education programs. Illinois isn't facing a gradual decline. It's facing financial implosion. When the next recession hits, tax revenues will plunge while pension obligations remain fixed. The result will be catastrophic: cuts to essential services, higher taxes, and an accelerated exodus. The pension bomb isn't ticking anymore. It's already sparking.